Defining a covered call is quite simple. It means you are writing a call on an asset you already own. In our real estate example, since you are writing a call on your house, it was a covered call because you own the house. One reason a covered call is a popular option strategy is because of its simplicity. We're going to cover some of the common reasons to sell covered calls. One is to write an out of the money. Wait, what do you mean out of the money? An out of the money option is one that, if exercised at that moment, would result in a loss. Therefore, an in the money option would result in a gain. And an option that is at the money or near the money results in little to no gain or loss. So in our out of the money example, the strike price would be greater than the price of the asset. With an in the money put, the price of the asset is less than the strike price. Okay, back to our scenario. Let's say you own 100 shares of Major Big Corp and you think the stock price is going to go up a certain price in a certain amount of time. So you sell a call for a strike price that is above that certain price at a certain time. The expectation is that the price of the asset doesn't reach the strike price before the expiration and you get to keep the premium. That is one reason to write an option. Another reason is that you want to keep the asset, but you think that the price might level off. In this case, you may want to write a call at the money, where the strike price is at or near the current price. Again, this is just to add a little money to an asset that you think will consolidate for a period of time. Finally, if you think the stock price is going to retract before continuing its climb, you can write an in the money call below the current strike price to protect your investment. I need to cover one piece of administration before I end this, and that is how much an option represents in terms of shares of stock. One option represents 100 shares. So the real estate example falls short on those terms because we don't own 100 houses. That means that if you want to sell a covered call, you need to own 100 shares of that particular equity before you can write the call. This leads us into a buy-write strategy, where you buy 100 shares of the equity and write a call at the same time. There are more uses for covered calls, but these are what I think are the most common and easiest to understand.